Hello, Earthlings. This is Attila Yeşilada, reaching out to you from Istanbul, Turkey, and you're at Real Turkey channel. Today, we're going to talk about Turkey's financial markets, and yours truly will humbly express his view that Turkey is in the process of becoming the darling of emerging markets investment world. Before I go any further, my conscience compels me to issue the disclaimer that this is not investment advice. On the other hand, if you are foolish enough to take investment advice from any influencer, you deserve to lose all of your money. Money doesn't grow on trees. No one gives you advice on how to make money free. Okay, let's get to the subject. Turkey has been the leper of the emerging markets investment world for years because of Mr. Erdogan's silly policies, which are politely dubbed heterodox economic policies, meaning they are outside the conventional practice of economic policy. And if you want to be more frank, they're bullshit. And these policies have brought Turkey to the edge of ruin many times with sporadic currency crises, inflation soaring, current account deficits getting out of hand, so on and so forth. I don't like to dwell on the past, but to put things in a context, when Mr. Erdogan's son-in-law, Berat Albayrak, was appointed economy czar, treasury and finance manager in 2018, I believe, the foreign financial investment stock in Turkey was estimated at around $150 billion. By the time Mr. Erdogan won May 2023 presidential and general elections, that was down to something like $10 billion. He surprised all of us by appointing Mehmet Simsek, who has been working very hard to go back to rationality. And investments in Turkey began increasing again. At this point, it's my humble estimate that we have roughly $50 billion of foreign financial investment in Turkish financial assets, excluding investments in Turkey-issued Eurobonds or FX-denominated bonds. Why do I think there is even going to be more coming into Turkey for the next 3, possibly 6 months? Several reasons. A, Fed. You don't have to be very smart to make money in emerging markets. If you have a strong view that US bond yields and the dollar index are going to decline by emerging markets, any emerging markets, there's an inverse correlation, you always make money. 2, underpositioning, which means none of the passively managed funds have enough Turkish assets in their portfolio. 3, Turkey is a story. It is, as I've said, Mehmet Simsek's austerity program, which for the rest of this video, I shall call economic stabilization program. Finally, Fatih Karahan, Turkey's central bank governor, gave an interview to Bloomberg. That's his first ever interview since he was appointed to the job, where he hinted that monetary policy will remain tight for the foreseeable future. For those of you who watch American monetary policy, he said things equivalent to higher for longer. Obviously, there are risks. There are always risks in any investment or financial asset view. Some of them are unforeseeable. We call these black swans. Some of them are very foreseeable but difficult to hedge against. in Turkey's case, this is Mr. Erdogan. This is a country with no checks and balances on Mr. Erdogan's exercise of executive authority. If tomorrow he fires Mehmet Simsek and goes back to policy of cutting interest rates to the bone to lower inflation, yes, this is not a translation error, neither have I misspoken. Mr. Erdogan still believes that the best way to fight inflation is to lower interest rates. He's the only one on this planet. This is the main risk. Two, if you watch my past videos, there is a prospect, not very highly likely, but definitely that needs to be monitored, that Turkey will face early elections by the end of 2025. And if that turns out to be true, the economic stabilization program is dead. No government, democratically elected or authoritarian or in a sham democracy, dares to face voters amidst an austerity program. Okay, let's start with Fed. Now, allow me to make another, just another personal note here. My personal opinions on emerging markets and on Turkey as an investment vehicle are extremely negative, but I don't want to waste my time, your time, with my views. What I'm trying to do in this video is to put myself in the head of an average hedge fund manager, an EM manager, and try to emulate her thought process. So, for instance, I don't think Fed is going to cut interest rates this year, okay? But that's besides the point. The market expectation is that Fed is going to start the monetary loosening cycle somewhere in the last quarter of this year and continue until mid-2026. As a rule of thumb, when Fed cuts interest rates, U.S. bond yields decline, the value of dollar against major currencies expressed as the dollar index declines in tandem, money swooshes out of American assets towards riskier assets such as emerging markets. Two, as I've said, underpositioning. It used to be that all hedge funds were actively managed, which means they all chased alpha. They always wanted to perform better than the market averages. That turned out to be a fool's errand for 99.99% of fund managers. As Eugene Fama told us 50 years ago, you cannot beat the market. If you want to beat the market, you leverage yourself. But it turned out, it became pretty obvious to savers that paying commissions to fund managers just don't make sense because they don't outperform the relevant market indices. So passive investments started. These are essentially emulators of main indices. Turkey's share in MSCI equity index is minimal, but is certain to rise. Turkey's share in bond indexes are much higher, but no matter how you look at it, if the financial assets of a country are appreciating, then these passively managed funds must buy more assets of those countries to stay at par with the index. Also, clearly, there is an emulation effect among even actively managed funds, which is that if one fund manager invests into Turkey and generates superior returns vis-a-vis her peers in this quarter, all others feel forced to do the same, whether they believe that that particular investment is lucrative or not. But there are also valid reasons to invest into Turkey above and beyond these international generalities. Turkey is a story. As I've said, Erdogan can spoil that story at any moment. I don't think he will until sometime in 2025. So let's discuss this story. the story is Turkey is a country with extremely high inflation. According to official measures, 75% at CPI level in June. I'm rounding up the numbers. And last year, this time, her current account deficit was about 5% of GDP, which is usually considered unsustainable. Moreover, the best defense against a run on the currency or the financial assets, which are central bank reserves, were negative. Now, what changed? Well, while Mr. Mehmet Simsek may be criticized for many things he has not succeeded in doing, despite his promises, or he has done wrong, he has done a stellar job in terms of shrinking Turkey's current account deficit. So much so that the latest available data, which belongs to May, shows Turkey's current account deficit to GDP ratio roughly declining to 2.5%. That, despite what many analysts would consider an overvalued Turkish lira. And I think Turkey's current account deficit to GDP ratio will decline to 2% by the end of the year, which mitigates pressures on the currency and prevents financial crises. It is also, to a certain extent, useful in reducing inflation, in the sense that, if your currency is stable, then the price of imported goods don't change in local currency, and then, of course, that, cuts inflation. 2, Turkey's inflation will decline from 75% in June to probably 50% or slightly below by October. This is not because Turkish monetary and fiscal policies are excessively tight, or that we economists observe strong signals of a collapse in domestic demand, but basically because of seasonality. Inflation was too high last year, so this time when those high numbers are eliminated from the annual figures decline. That being said, Turkey's current exchange rate policy of keeping Turkish lira strong is also helping reduce inflation. And even though these could be reversed in the coming months, there are some signs that domestic demand is cooling too. Since currently, the primary reason for Turkish inflation is excessive demand. It's demand-driven inflation. Any signs of cooling domestic demand are harbingers of lower inflation. Turkey will probably close the year with 45% CPI vis-a-vis 75%. Now, in comparison, I don't expect monetary policy to be loosened. Currently, policy rates are at 50%, 53% per annum to be effective, which compounds to something like 6 to 2 or 6 to 4% per annum. So when inflation declines to, say, 45%, but the central bank's policy rate, which serves as the sort of benchmark interest rate for all loans and deposit, remains at, say, 60% compounded, we have a huge real positive interest rate. And that is always, of course, positive for investments into bonds. There is a discussion among analysts that as inflation declines, central bank will also cut interest rates. I don't agree with that, and I think the Bloomberg interview with central bank governor Fatih Karahan adds weight to my viewpoint, where he said two things which he hasn't pronounced in the past, and which are extremely hawkish taken at face value. First, as those of you who are well-versed in economics know, central banks conduct monetary policy not only on the basis of headline and core inflation trends, but also on inflation expectations. There are various ways to measure those. In Turkey, the primary tool to measure inflation expectations was a monthly survey by central bank with something like 50 participants. And that showed a steady decline in inflation expectations. No one believed that. We have a lot of poll data indicating that the households and the business world have much higher expectations about inflation in the next 12, 24 months vis-a-vis that particular survey. Finally, central bank, from the mouth of Fatih Karahan, admitted that in conducting monetary policy, they will not only pay attention to their official inflation expectations survey, but to separate surveys the bank now conducts monthly among households and businesses. And these are like twice, 2.5 times higher than official inflation expectations. There is a huge gap between what households think where inflation will be in the next 12 months and what central banks' official surveys show. If central bank were to conduct monetary policy according to its own survey, it should be cutting interest rates. Were it to conduct monetary policy according to that household survey, then monetary policy should remain tight for the foreseeable future. And I think this is the case. Now, Fatih Karahan finally acknowledges that their own survey is crap, and until the bank sees a significant decline, the average person on the street thinks inflation is declining. They're not going to touch interest rates. He also made another comment. He said, for us to loosen monetary policy, it's not enough to get close to our target CPI for 2024, but also to our target CPI for 2025. Currently, central bank's target CPI, Consumer Price Index, for year-end 2025 is 14%. Now, that will be revised upwards, but even if it were to be revised at 20%, going from the current 75 to 20% is obviously a very long journey, which also made me think that central bank is not in no rush to cut interest rates. And that's, good for foreign investors, because if a central bank loses interest rates before inflation expectations come down, usually the currency loses value, even if the local currency value of financial assets continue to appreciate. Any fund manager who keeps her accounts in dollars or euros ends up losing money because the currency is weaker. So when you get a combination of a strong currency and high interest rates, that's good for Turkey's financial assets. And I think this is how the average fund manager is going to formulate her investment process for the next 3 to 6 months. And as the first brave few begin buying, the others will follow. I think the most lucrative financial asset is going to be the stock exchange. But I think Turkish Lira bonds could also stand to appreciate. But that's besides the point. As I've said, I'm not giving you investment advice. The point I'm trying to make is that after a very long stay in the boondocks or out in the wilderness, Turkey is back to the emerging markets world, and to the extent funds flow from United States and other developed nations to emerging markets, Turkey would be one of the leading recipients. By the way, IMF recently published a blog commending emerging markets for their resilience, and to the extent I understood its text, the bank expects financial flows into emerging markets to continue. Another advantage for any emerging market is that China, for regulatory reasons, and Xi Jinping's newly communist policy is basically uninvestable, and Russia is obviously close to most Western fund managers. And India, although I'm sure it has a much better story than Turkey, is quite expensive. For the time being, I think Indian stocks are fairly valued, whereas a case can be made despite huge uncertainties about the profit outlook. Turkish stocks are much cheaper. But I'm just adding these to sort of, grandstand to show you that I know something about emerging markets. Now, as I've said, every view on investment must consider risks. Erdogan changing his mind and going back to his silly economic policies is always a possibility. But a bigger danger is that, for reasons I have explained in my past videos, and if you comment, I shall explain again, early elections are a possibility by the end of 2025, and traditionally 6 to 9 months before scheduled elections, governments loosen monetary and fiscal policy, which is of course good for the voters because of increased welfare spending, but bad for financial investors. Thank you very much for watching another video of Real Turkey channel. This is Atilla Yeşilada saying goodbye from Turkey.